Welcome to Money Moves, our personal finance feature brought to you by 274 Investment Managers. Every week we bring you a guest to discuss and share with us ideas on how to preserve our money and make it work for us. Tonight, I'm joined by Nthime Khoele from Bopamuruo Private Equity to discuss with us an approach to private equity investments. Nthime, pleasure to have with us.
Thank you, Martin.
Right. The whole equity story, I had a short chat with you before we started with the interview. Is how do you measure it? What is the size of it?
So maybe it's worth starting at the beginning and saying what is private equity and what is how we work. So private equity is what the name says, entails. It's buying shares in private businesses.
Right.
And how it works is that investors pool money in funds which then invest in these private businesses. These funds are managed by private equity fund managers, and the funds as a total size we estimate to be 170 billion.
So this would be unit trusts and those types of...
Not quite. So they would be called private equity funds, which are very different from unit trusts. So
all right, and there are specific companies that deal with it. And
correct.
The size of the investments by those companies.
Correct.
Okay, but it's not a reflection of the total market itself.
It is a reflection of the total market.
Okay, but if, for instance, I'm a private investor and I'm buying shares in one or other company, would you count that as well?
So private investors generally go through private equity managers in order to access these opportunities in private equity space. So there is no ability for a private investor to go directly into the retail market other than through two known retail channels, which Old Mutual handles, and I think Ashburton is the other business that has a retail product. So, but largely it's an institutional product that pension funds, institutions, family offices, they commit money to private equity managers who pool those into funds and then do the investing on their behalf.
So tell me about the banks offering their clients opportunities to invest. Is that something different?
So generally it's non-bank financial institutions that offer clients this option. So you'll find your insurance companies being the major players in this space. But largely your pension funds generally invest in this product. So it's not a type of product that you're going to find as part of a banking product suite.
Okay, let's talk about equities then, and how you go about making the investments. There are a number of key issues to consider when you do that. And I suppose even before you get to equities, you've got to check the broader portfolio to use the language, right? Then are you in bonds, property, and so on? Explain that first as an approach.
So as an approach, I mean, each investor has their own asset allocation, which is what you just described, whether they're allocating their capital to bonds, to cash, to property, or to equity. Now, within the equity space, you've got public listed equities, which is what people do when they invest on the Johannesburg Stock Exchange. Now, private equity is a subsector of equity allocation. It's what's called part of the alternative investment allocation. Now, pension funds are allowed to invest up to 10% of their assets under management to alternative investments and private equity. So it's a decision that one takes, obviously, in the context of your wider portfolio, and we get a small slice, basically, of someone's wider portfolio.
So from then on, how do you evaluate the different available equities that are there on the market?
So once an institution commits capital to a private equity manager, a private equity manager then knows that they have this much capital, let's call it R1 billion, that they can go and invest. Now they have around 10 years in which to take the capital, invest it, grow it, and then return it back to the investors. So in terms of how it gets invested, you have to have a team. You have to have an experienced team, a skilled team that is able to source investment opportunities, execute those investment opportunities, and once those investments are made, manage them to growth. And once you've managed them to growth, exit them at the end of a certain period. And that's where the value add of a private equity manager comes to the fore.
Well, help us then think like private equity managers. If we are going to, you wouldn't advise that a person tries it by themselves, do you?
Tim, I think in some way we all do on a small scale.
Yes.
But I wouldn't quite advise people to take own capital who have no experience in investing in businesses, in assessing businesses, in assessing risk, in pricing risk, in executing transactions, in using debt prudently in the execution of those transactions, and in managing companies thereafter. So if you don't have that experience of going through all those processes and steps, I wouldn't advise that you do it yourself.
But be that as it may, just talk me through those steps then that you have to consider when you invest in equities.
So the team is paramount. You know, the team that you're backing to invest your capital is paramount. So, I mean, you've heard, I'm sure, many times on the show about asset managers and the views that they have on the market, the teams that they have to manage your capital. And it's a similar in private equity. The teams that manage your capital either make you a return or lose your money. So doing some research on the team and the institution that you're backing is of paramount importance. Now that team, obviously the process that it goes through is effectively originate and source those transactions. Then it will assess and value the transactions that are available to it, structure value accretive transaction structures that are efficient from a tax perspective, from a capital perspective, and thereafter manage those companies that they're invested in to make them better, more competitive, but to build value in those companies, after which they will then achieve an exit in those opportunities.
Now, if you are an investor in such an equity fund, what should you look for? Because there are numerous such funds, right? And you would know, or even for yourself, out of your own interests, so what should you look for?
Track record. So track record will tell you what the team that you're investing behind has done before and what their capabilities are, what opportunities they can access, and how they manage the portfolios that they have, what sort of companies they look for, and how they manage the exits. So track record gives you a window into what the performance of that.
But I suppose the track record in context of the market as well, obviously, I suppose.
In context of their returns, so in the returns that they generate.
Yeah.
But now sometimes, obviously, these investments are made in an environment where the economy is not growing well.
Yes.
And therefore, you got to look at sort of relative returns relative to the other opportunities that you had to invest your capital into.
Now, we talk laypersons like myself about the economy in a broader general sense, same way as most politicians would, I suppose, that economic growth is 1%, likely to be less than 1% this year. And on that basis, you might think that your investments should, it's reasonable if they grow at less than 1%, because after all, the economy is growing at that rate. But that's not really the number to look out for, isn't it? You've got to look at other things.
Correct.
Yeah.
So, I mean, the economy growing at 1% is a macro. It's a macro economy. There are pockets within the economy that are growing faster than that, and there are pockets that are growing much slower than that. There are pockets that are contracting, there are pockets that are growing. So it's the skill of the investment manager to look for pockets of growth and pockets where, even where there isn't growth, but there is a mispricing in the market. So your investment manager needs to identify opportunities where they can extract return even in a 1% growth economy. So your ability to source and look for those types of opportunities is what differentiates you from other.
The past
managers.
10 years, on average, what would you say was reasonable growth, or the average growth?
Well, in terms of private equity investing, and which is, I suppose, one of the attractive features of it, it has outperformed listed equities over the last 10 years, as per a South Africa study that was done late last year. The general market return on average around just over 17% annual growth. So
17?
17.
That's substantial.
So that's a listed market. But private equity return on average over 21%. So there's a outperformance element to private equity that lends itself to this asset class.
Yeah.
So, but I mean, also the last 10 years aren't what the next 10 years are going to look like.
Yeah. So but anyway, there was money to be made.
There was money to be made.
All right. There you are, 17% and 21%, much more than inflation. You subtract that, and that would be your growth.
Sure.
Right. Well, Nthime, much appreciated. Thank you very much. Right, he's with Bopa Muruo, and that was very interesting conversation. We learned a lot about equities, and of course, if you're not paying attention, then you might have missed out. Over the past 10 years, average growth of 17%. Inflation rate was at about 6 or less percent. Anyway, this is Money Moves. We'll be bringing you another feature next week. Make sure you join us when we discuss your own personal wealth. We'll continue with the show.